Trivariate's Adam Parker is here with me at Post 9. I'm calling it that because we had the PPI, on Wednesday. Stocks rally up. Everybody's like, all right, worst is in. This is the peak inflation rally now. What happened? Where is it?
I think people are trying to figure it out still. And maybe as I told you a couple of weeks ago, I don't think we're going to get more hawkish from here. One thing I've been talking about investors every day lately is, can the Fed raising rates actually solve some of the shortages we have with labor, with semiconductors, with wheat?
They say no.
Probably not, right? So maybe they're going to act a little bit less aggressively in the end than some people think. And I believe that. And so we'll see what happens, but certainly I don't think 7, 8, 9 hikes is what's going to happen.
So I mentioned at the very top of the program that Jim Bullard is literally on stage as we speak with Steve Leisman.
Right.
He might as well walk around dressed like a hawk, because he is arguably the most hawkish, and there is the conversation between Leisman and Bullard now. And you better believe that the headlines that come out of this conversation are going to be as hawkish as it gets. So what do you cover your ears? You don't want to hear it?
You know what's interesting? If you look at the Fed Fund futures and you look at how they trade versus the growthier industries, biotech, software, life sciences and tools, it was very statistically significant from November through February, March, and it's actually started to wane recently where the stocks aren't really trading on that as much anymore. And it could be because they're down so much that maybe the risk rewards got more balanced. Listen, I'm not saying that the Fed won't continue to act. I'm just saying if they act too much, we know it's not going to resolve the issues. I don't believe that they're going to purposely create a recession. And so I think they have a slightly better chance of, quote unquote, threading the needle than maybe the consensus view.
How closely are you watching the bond market? Because that seems to be where the real action is these days. You have the big move up in rates of late. That catch your attention?
Very, very carefully. And I think the Fed Fund futures is actually even more important because that's the perception of rates, not the reality. And that perception has not moved as much recently after moving much more in the fall and through the spring. So I think that's the key thing to watch. Underneath it, there are tons of opportunities within equities. In some ways, I feel more excited about the long-short potential in U.S. equities than I have at any time in the last several months.
Tons of opportunities in equities?
I do. I'll tell you why. 55% of small caps trade below 15 times earnings. A lot of them have earnings growth. So I look at the bond market and I say, okay, 2.5%, 3%, duration risk, whatever I have. Look what I've got in equities. I've got earnings 5, 6, 7%. The consensus is 8.5%. I've got a buyback. I've got a dividend. As you know, we've been massively bullish for a year plus on energy and metals. Those things go up every day, and I think we'll continue to. So healthcare services, there's so many things underneath that have pricing power. So I think it's a great time to be a stock picker after Q1 being a pretty bad time.
See one headline here, markets have priced in Fed tightening. That's an interesting point of view from Bullard. If they've really priced all of what he would like the Fed to do. You mentioned something interesting. So you don't think the Fed wants to put us in recession, right? Maybe they don't. If they don't put us into recession, can we agree that they may put us awfully close? So if they put us awfully close, how can those stocks like small caps do well? You know the economy's going to slow.
Yeah, I mean, look, the S&P 500 is not exactly the economy. You know this well, right? So could we get a negative GDP? I don't know. But can the S&P 500 earnings still be up 5% when there's a negative GDP? Of course it can, because all the businesses have massive pricing power. One thing people don't understand is every year you replace the S&P 500, 6% of the companies, 30 new ads. They grow fast and are expensive. And you take out 30 companies that are terrible. So it's a moving and improving target you're chasing of faster growing businesses. So I kind of think the S&P is the way you can play relative to any bond, really.